Greetings, everyone. Welcome to Liberty Call. It's Thursday, November 3rd, 2022. Hope everybody's having a good day out there. We are getting a little bit of snow here in the Rockies. It's not really sticking. Looks like it's a little too warm outside, but we do have snow falling, and we'll probably get a few inches through today and tonight. So exciting. I might actually get to use a snowblower if I can get it started. I haven't started it since the springtime. So anyways, if it's your first time watching, please press those subscribe, likes, and all that good stuff down here. I'd greatly appreciate it. Share it with friends and family. And let's go ahead and dive into the markets. Not great today. Again, we did have the market rally yesterday, right at the beginning when the Fed raised rates again. And then Powell came out and crushed all the hopes of the people who thought that they were going to slow down on rate increases and pause. And yeah, that's not going to happen anytime soon, at least until inflation starts to fall. So, but the Dow Jones was down 0.46%, closed at 32,001. S&P was down 1.05%, closed at 3720. NASDAQ was down 1.73% today, closed at 10,342. Small caps were down 1.13. The VIX fell 2.4%, which is a little strange. It's currently at 2524. Let's see. Canada was down 0.19. Brazil was up 0.06. Mexico down 1.23. Jumping across the Atlantic earlier today, Germany was down 0.95. UK was up 0.62. France down 0.54. The Euro Stoxx down 0.8. Netherlands down 0.91. Spain down 1.25. Italy down 0.43. Switzerland down 0.89. And Portugal barely up at 0.09%. Moving further east, both Russian exchanges were red. The MOEX was down 0.82, the RTSI down 1.3. And the overnights in Asia, all red from what I'm seeing here. Japan was down 0.06, Australia down 1.84, New Zealand down 1.07. The Shanghai was down 0.19, the SESE component down 0.34, the China A50 down 1.28. DJ Shanghai down 2.23 and the Hang Seng down 3.08. Taiwan weighted came in down 0.87. So for trading day, November 3rd, not real great. I mean, there were a few things that were up. The UK up over 0.5%, but that looks like about it as far as anything significant. So not the best day in the markets, but again, with the corner that the Fed and our governments have painted us all into, and I'm not just speaking about the U.S. government, all these other central banks and large countries did basically the same thing our government did, and printed a bunch of money, created a bunch of stimulus, and are now sitting there wondering what the hell happened? Why is inflation so high? Well, read an economics book that's not Keynesian, and you might actually understand that when you increase the money supply, you got too many dollars chasing too few goods, and prices go up. So, anyways, all right. Well, let's read through today's market recap. S&P 500 moves off lows, but stumbling tech piles on pressure amid rate hike fears. The S&P 500 moved off session lows Thursday, but remained under pressure as big tech continued to stumble amid rising treasury yields as investors price in the prospect of more rate hikes. Oh my God! Tech added to losses from a day earlier as the 10-year Treasury yield traded close to highs for the year after the Federal Reserve Chairman Jerome Powell indicated Wednesday that rates will have to be raised to a higher level than previously expected. Quote, the FOMC hiked rates at 75 basis points at its November meeting and underscored that ongoing increases will be necessary, end quote, Morgan Stanley said in a note. Apple led the move to the downside for big tech, falling more than 3%, followed by Google, Microsoft, and Amazon. Quote, if Apple, Amazon, and Microsoft keep going lower, then it's going to be awful hard for the S&P 500 to rise as these companies make up such a large share of the market, end quote. John Luke Tyner, portfolio manager at Aptus Capital Advisors, said in an interview with investing.com Wednesday. This move lower could push the S&P 500 to about 3,200, well below current levels of about 3,729, John says, leading to a, quote, more reasonable valuation multiple on the S&P 500 to about a 14 to 15 times price over earnings multiple, end quote. On the earnings front, meanwhile, delivered mixed quarterly results. Under Armour climbed more than 13% after reporting quarterly earnings that topped Wall Street estimates, though the athletic apparel maker did narrow guidance amid a, quote, challenging retail environment, end quote. Peloton Interactive cut gains to trade more than 5% higher as management said the connected fitness equipment remained on track to achieve break-even cash flow by the second half of next year. Comments offset quarterly results that showed a wider than expected loss for Q3. Zillow reported a beat on both the top and bottom lines in Q3, though warned of lower revenue in the final quarter of the year as rising mortgage rates weighs on demand. Excuse me. Energy rose more than 2%, shrugging off falling oil prices, but some see prices resuming their trend higher as the end of sales from the Strategic Petroleum Reserve could exacerbate supply concerns. In other news, Boeing, a major Dow component, jumped after the aircraft maker detailed plans to increase production and deliveries of new aircraft. All right, so that's the good and the bad as far as everything going on today. Let's read through some information on the labor data. U.S. labor market resilience persists. Productivity remains weak. The number of Americans filing new claims for unemployment benefits unexpectedly fell last week, suggesting the labor market remained strong despite slowing domestic demand amid stiff interest rate hikes from the Federal Reserve to tame inflation. The weekly unemployment claims report from the Labor Department on Thursday, the most timely data on the economy's health, followed on the heels of the news this week of an unexpected jump in job openings in September. Labor market resilience gives the Fed cover to continue continue tightening monetary policy and also keeps the economy growing for now. Quote, there is still no indication that layoffs are picking up in any meaningful way, said Dante D'Antonio, senior economist at Moody's Analytics. Quote, the ongoing lack of layoffs will help propel consumer spending moving forward, even as household balance sheets come under pressure from high inflation, end quote. Initial claims for state unemployment benefits slipped 1,000 to a seasonally adjusted 217,000 for the week ending October 29th. Data from the prior week was revised to show 1,000 more applicants filed than previously reported. Economists polled by Reuters had forecast 220,000 claims for the latest week. Unadjusted claims rose 1,174 to 185,594 last week. They were lifted by a 2535 jump in filings in California, as well as an increase of 1566 in Oregon, which offset an 1832 drop in Florida as the effects of Hurricane Ian faded. There were also notable decline in claims in Kentucky. Claims bounced around in a tight 214 to 226 range in October, though there have been an increase in layoffs in interest rate sensitive sectors of the economy like finance, technology, housing. Employers have generally been hoarding workers as labor remains scarce in some service industries. The claims report also showed a number of people receiving benefits after an initial week of aid. A proxy for hiring rose 47,000 to 1.485 million in the week ending October 22nd. The data has no bearing on October's employment report scheduled to be released on Friday as it falls outside the survey period. Though unemployment rolls remain small, there has been an uptick in layoffs. A separate report from global outplacement firm Challenger, Gray & Christmas on Thursday showed job cuts announced by U.S.-based employers increased 13% to 33,843 in October, the highest since February of 21. There was a jump in planned layoffs in construction, technology, industrial goods, and warehousing industries. Quote, we are beginning to see more job cut activity in the fourth quarter, historically when the bulk of cuts occur, as companies finalize budgets and plans, end quote, said Andrew Challenger, Senior Vice President at Challenger, Gray & Christmas. So again, job market still looks pretty good, but I would warn everyone out there that typically the job market is the lagging indicator. Companies have to start losing money before they start firing people. So, that'll probably, as the economy slows down even more as we go into next year, we'll probably see more of those layoffs pick up. Markets will bottom out. Businesses will start to make more money and then they'll rehire. So that's the way the business cycle works in this boom bust situation that the Fed has created for us. All right. One last article here. It's titled David Stockman on What History Tells Us About Taming Inflation. This comes from Zero Hedge. In the spring of 1980, Paul Volcker did engineer a mini recession, but it didn't put a dent in the inflation momentum. As shown below by the purple line, real GDP peaked in Q1 1980, then declined through Q3 1980 during Volcker's mini recession. And you can see the real GDP dips while producer prices continue to climb. During the two-quarter interval of shallow and short, real GDP contracted by just 2.2%, but the inflation rate, the brown line, just kept climbing, rising at an annualized rate of 9.5% during the period. The second round of Volcker anti-inflation medicine took another chunk out of real output, this time 2.6% from the Q3 1981 peak to the Q4 1982 bottom. Still, inflation stubbornly resisted the recessionary medicine, rising at a 5.3% annual rate during the five-quarter downturn. And again, you can see GDP falls and prices, continue to leg up until it slows down a little bit here at the end. Moreover, the impact of the labor market was severe over the course of the double dip recession. The U3 employment data rose from unemployment rate rose from 6% in August of 79 when Volcker took the helm in the Eccles building, the Fed headquarters, to 10.8% at the December 1982 bottom. Likewise, the number of unemployed nearly doubled during this period, rising from 6.3 million to 12.1 million. Accordingly, purging the virulent inflation that became embedded in the wage price cost nexus looked nothing like Joe Biden's itty-bitty recession, nor the soft landing Wall Street bulls never stopped peddling. As it happened, core PPI inflation did not return to 2% zone until Q4 of 1983. That is, it took Volcker 2 recessions and 4 years to wrestle the core PPI rate back to the Fed's current purported inflation target. By any definition of that term, that's not short and shallow. When it's all said and done, Volcker's conquest of the 1970s inflation came at a steep price to the macro economy because there was no alternative once the inflationary spiral became embedded. In fact, the chart below makes the cost of the double dip recession plain as day. To wit, real GDP of 6.82 trillion in Q4 1979 when Volcker threw on the monetary brakes was still at 6.81 trillion in Q4 1982 when the economy finally hit a bottom. That is to say, 3 years of zero net growth in real output. But even then, the core PPI, which runs lower than CPI, was still at 4.7% in Q4 1982. Consequently, Volcker did not get the Fed funds rate under 6% until October of 1986. Needless to say, the Volcker era proved that stagflation is a stubborn beast once it worms its way into the price structure of the economy. Back to today, in short, a bad stagflation is here, since the Fed will be locked in a battle to tame the price side of the equation, even as real output falters for months and years to come. We seriously doubt the economic contraction to be recorded on Joe Biden's watch will be described in the history books as a very slight recession. So, again, we have a long slog to get back to a state of normalcy, and it's not going to just happen overnight. As much as these nitwits on TV and at the Fed and in our government think that just sprinkle some fairy dust and it'll all be okay. It's going to take a while, folks. So my advice: be in a profession that is in demand, because if things go sideways, you want to be able to change employers if need be, get out of debt. Have some food stores if things get really bad. But, it's kind of like hurricane season. You always want to be prepared, for the unknown. And, we're headed into, we're definitely in the middle of that cycle at this point. So if anyone needs anything from me, please go to dsafinancialgroup.com if you want to get your finances back on track, plan for retirement. Hopefully there is one for most people. And, or if you just want to send me a note or drop me a phone call, all my information's there. So hope everyone has a good night, and I'll be back tomorrow with the weekly wrap up. Ciao.